Hello traders, and welcome to a new day trading strategy video of mine. In today's video we're going to be talking about dollar cost averaging. And the reason I'm doing this video is it was my Patreon suggested. After 6 weeks of it not being voted, today it was voted on to be the topic. So that's what we're going to be talking about today. As you can see here, this is my new little office in downtown. So I'm not going to be filming in some more random locations that I used to be filming. But now I'm going to be filming in an actual office, which is definitely going to be better. Okay, so let's start off with the price prediction challenge like we normally do. This week, price prediction challenge was phenomenal again. So this is what Sergeant Crypt, the user on Discord, had predicted. So he predicted that price would just go like this to 0.74850. And this is what Ripple actually did. So XRP was not completely flat. As you can see, we did have a bit of fluctuations there. But what it actually did was he thought the highest price would be 0.7485. And the highest price was actually exactly 0.75. So he was incredibly close to the accurate prediction. And yeah, I think he got this one really on the nose. Phenomenal prediction. He predicted that price would just stay flat for a bit, and then it would probably eventually move down after this bear flag. As you can see, he put a picture of a flag, which signifies that. Looks like he used Stoke RSI. This looks like MACD, and this looks like OBV, on balance volume. So yeah, great prediction, Sergeant Crypt. I think this is his second win. Out of the 4 weeks we've done this, I think he's won half the time. So yeah, some technicians are quite good at predicting prices, as you can see here. Okay, so let's get into dollar cost averaging. So what is dollar cost averaging for those who don't know? It's the spreading out of an investment or trade to take advantage of the fluctuations within the market. The market isn't always going to be just moving up or down. It's going to have fluctuations as it moves up or as it moves down in a more longer term trend. And what can cause a lot of traders an issue is trying to always buy a market bottom and trying to always sell a market top. That can be risky and quite difficult. So this theory looks at buying more shares of a coin when price falls and buying less shares of a coin when the price rises. That's how most DCA traders and investors are going to operate. And it's going to reduce your risk as partial investment allows for more flexibility within the market. For example, if you invest 20% and then you see price just crashing, DCA would tell you probably to buy, but if you think the price will just continue going lower, you might just not buy and just take a small loss of 20% of your capital. And compare that to, imagine if you had put in 100% of your capital and the price just dumps and you don't put a stop loss because you're investing. Then your loss is much, much greater, actually 5 times larger than if you had put 20%. So this is the amount of flexibility that DCA gives you, which can be quite useful. So that's why I say here that average price is typically better than lump sum price. The only time where where lump sum price is going to be obviously better than average price is a strong uptrend, where DCA isn't going to really let you buy into that uptrend because the uptrend is so strong. There are 2 ways of doing the DCA. You can average over time, or you can average over price. Averaging over price is what we've just talked about, which is buying more shares of a coin when it falls, buying less shares of a coin when it rises. Averaging over time looks at a fixed schedule, either daily, weekly, monthly, quarterly, or yearly, and putting in a % amount of capital or USD amount of capital throughout time. And this can be done for traders who want to play the long game for investing. And that brings us just to the first point of DCA, because I want to break this off into 2 different kinds of dollar cost averaging. A lot of traders like to talk about the holding investing type of DCA, and that is what I'm going to be talking about here. But there's also trading using DCA and not allocating all your capital at one fixed price point, but rather averaging over various prices. And we'll be talking about a few different strategies that one can do to achieve that. So investing with using dollar cost averaging eliminates the short-term trading risk. Trading can carry high risk, especially if a trader doesn't use a stop loss, and especially if a trader is prone to emotions like greed, buying tops, and fear, selling bottoms. Investing into crypto would be more of less technicals, I would say, especially way down the line, unless you're an Elliott wave technician and you trust your Elliott wave theory. More of just a belief in the long-term progress of crypto, especially if you invest in Bitcoin or Ethereum or the higher market cap coins that you believe will likely be here in the future. And like I said, this eliminates the stress and the difficulty of trying to buy bottoms and sell tops. So you can actually do reoccurring purchases with Coinbase. And this could be optimal for monthly salary earners. So what I showed here is Coinbase allows an option to click repeat this buy. And if you repeat this buy, then you could do daily, weekly, every 2 weeks, monthly, or whatever. And what it'll do is it'll take money from your debit card or it'll take money from your bank account. And it will allocate the money no matter what the Bitcoin price is. So this can be a good way if you want to invest, like, let's say 10,000 into Bitcoin, but you don't have 10,000 on hand, but you earn a few thousand per month and you want to allocate 500 per month into Bitcoin. Well, then you could just hit monthly and 500 USD and it would take it out of your paycheck. So this is one way that a trader who doesn't really care about the technicals, but more just the fundamentals of long-term progress of crypto, who might want to invest into Bitcoin or Ethereum. And just to show what would have happened if someone had been DCA investing for the past year, as many traders probably know, Bitcoin has performed phenomenally in 2017. And it's only been 2018 where the downtrend has really begun to take foot, as you can see. So if one had done DCA, just a rudimentary way to do it, they could have begun to buy here and then begin to buy, and then the DCA trader would actually want to hold, not sell, but just hold the trade. Here, as you can see, hold, and then potentially buy whenever the market goes down, buy when the market goes down and continue to hold. And then here, they would probably be still holding unless they alter their strategy to maybe a trading strategy or just wanted to, exit a certain percent of their fund. They could do that as well. And the exact way to do this is something that I'm going to cover later in the trading section, which brings us to DCA trading. So we don't always need to hold for months or years to use DCA. We can use DCA trading to average our risk, to be more flexible, meaning that, again, if price skyrockets upward or skyrockets downward, we can adjust our strategies to potentially not sell when, not sell or just hold when prices skyrockets upward, and not buy when price skyrockets downward, something like that. And I also said here, lowered loss if you employ that kind of flexibility into your DCA. Of course, if you just place limit orders, which is possible, if you just tier limit orders down the order book with DCA of, like, let's say a spread of, like, a limit order here and then 200 lower and a limit order here, then when if the price does go quickly down, your losses would likely be much lower than if you had just bought here. Because 100% here versus 20%, 20%, 20%, 20%, you're going to be losing a lot less money when that happens. One other thing that I don't think, too much of what I read up on DCA didn't really talk about large capital trading. So institutions or even large retail traders, whales, they can't always just place a limit order or just place a market buy order to enter the market. That would not probably be the best idea, because if they just placed a market buy order, that would probably be the worst option. They'd be paying high fees. They'd be cutting through the order book, buying at progressively worse prices. And potentially they would also cause a volume spike and price might just go down. If they put a limit order, what might happen are two scenarios. One, if they put a large limit order just right at the top of the order book, price might begin to buy up, and then other traders might front run that order by putting their bids above that large bid. Or even worse, if price is in a downtrend and someone just puts a large limit buy order, that might not actually just propel the market upward, but what might happen is many traders might take advantage of that large bid order on that exchange and then sell until price just cuts right through and goes much, much lower. Just giving some traders a better opportunity to sell at the expense of that whale who's trying to put that bid order to try to buy in. So that's why DCA can be necessary for large capital, where instead of having those issues of placing a large limit buy order and then just hoping it gets filled and price doesn't slam right through it, one could put 10%, 10% down here, 10% down here, potentially 10% if price goes up, and then try to buy there. And then different kinds of ways of doing that. So that's one way that if you are a trader who carries a large amount of capital, then that would probably be a way to do it. Okay, so now we want to talk about allocation. So how exactly can a trader use dollar cost averaging when we're talking about trading? So there's Fibonacci DCA, and this is just one that I put in. If a trader believed that this was a strong uptrend and the price was likely to continue, a trader probably wouldn't want to just put their bids here or even all their bids at the 38.2. What they could do is put 25% of their capital here, 25% here, and then 50% at the important 61.8. So what would have happened here, and this is a hand-picked example of course, is all orders would have gotten filled, but we would have gotten to fill about half of our position here and around half of our position up here. So the average price would probably be somewhere around here-ish. That's probably bad math, but somewhere around here instead of buying here. And this is going to give us a much better fill price. And then we go up. And how do we sell when we use Fibonacci DCA? Well, we can just do the same thing. We can just use more Fibonacci retracements. So if we see a strong downtrend, we can draw a Fibonacci on that downtrend and then just sell half or even all of our position if we would like to at these tiered orders. So what I put here was, let's say that we had seen this downtrend, we sell 50% large amount of our position after the strong downtrend at the 61.8. Completely makes sense. This is something that a DCA trader might just do. And then they would wait for the next strong downtrend. This one they might pass on, this one they might pass on because there's no follow-up. Here we see consistent follow-up, the market goes down. So maybe a trader could put Fibonacci from here to here, and then sell 50% at the 61.8, or even just sell up a little bit at the 38.2 as well. And this is going to allow the trader to just ease out of the market without liquidity issues if they're trading with large capital, and really just have a plan of action. And this would have saved some money as the market went down after that. So Fibonacci DCA, of course, can be used for both investors and traders. Just investors might be using the 1 day or 3 day chart. I would recommend this strategy more for traders though, because I feel like that investors might have an issue with this because the long-term nature of Fibonacci's can be a little bit tougher than I've found that the short-term nature can be. That's a story for another Fibonacci video. Okay, so there's another strategy, and the reason I put a star next to this one is it can be used for, this one can definitely be used for traders and investors who want to use dollar cost averaging. So what a trader can do is have a fixed plan of whenever the price goes down 5%, I allocate 25% of my capital to go into the market. So what that would have done here is after they see a strong bull run here, once they see that 5% drop from this bull run right here, you can see 5% would be down here. They would buy in, and then price goes up. And again, they would wait for that 5% drop, and then that would trigger a buy order, and they would buy right in here. Price does not go down 5%, unfortunately, here, but it goes 5% down here, and then 5% down one here, and we would have bought in both of here. And this would have been a really nice uptrend to catch for a trader who's trading over a few weeks or a few days, as you can see here. And the up-down method of just selecting a percent and just going with that percent, of course, I picked 5% because that's just an arbitrary number. And we would have also gotten in here because that's minus 5% and that's minus 5% as well. But you could use minus 0.5%, you could use minus 6%, you could change the percent of minus based on the state of the market. It all just depends on how you want to dollar cost average your trading or even your investing if you want to play the long-term game. So investors could just use the strategy of just whenever the market goes down 5%, I am going to buy. And I will take a loss if the market goes down, like let's say 15%, I take a loss. And that's not a bad strategy to use going forward to invest, because this would have been a very nice game, as you can see here. So the final strategy, and this is one that I think is very short term, but it can also be used for more long term as well, is looking for volume spikes. So whenever there's a spike in volume in the market, typically that represents a change in the market's direction. So imagine that we see some volume spikes down here, and we believe that this is the end of the downtrend, but we don't want to allocate all of our capital because that would be high risk. We could allocate 40% of our position because we see a volume spike here, and then we could allocate 60% of our capital on the next bearish volume spike. We get that bearish volume spike here. This annoying thing keeps popping up, but you can see that there's a volume spike that had occurred there. That's about 4 times the moving average. And if you had done that, you could just have the strategy of whenever we see massive bullish movement and also a massive volume spike, we are going to sell a part of our position. So we see a massive volume spike and we see a massive bull move here. So we could just take out half of the position that we accumulated here, and we could just wait for another bearish volume spike, and then volume spike down here, we DCA 25% in, another volume spike around here, 25% in. We could potentially sell here, volume spike and massive bullish movement here. So this could be a selling opportunity. And we could then just wait for the next massive bullish volume spike. Could get out here, but then you see this one, and if you hadn't gotten out, this one does not look good. This is a high tail and a massive volume spike. And the volume spike, if you had not known this information but just known this, was met with immediate bearish pullback, which is not a good sign for the bulls. So this would be a way that a trader could use volume spikes to try to DCA into the market and also DCA out of the market. So that's going to be it for this video. We've gone over the price prediction challenge. We've gone over what is dollar cost averaging. We're spreading out our risk. We're spreading out our buys and sells to have more flexibility in the market and to prepare for different types of scenarios. We can average over time. We can average over price if we're trading, or even we could average over price if we're investing with a type of up-down strategy of -5% or -3% to buy in, and then sell with a plan of taking profit and sell with a plan of a stop loss, as you can see. So that's going to be it for this video. I hope you enjoyed, and happy trading.